Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
I had someone email me the other day that said that the BRRRR strategy doesn't work anymore, that in this market, you just can't make the numbers work on a BRRRR. Peter and Ron, I wanted to get your take on this. What do you think? Can you still BRRRR in today's market?
Yeah, I think you absolutely can. I think it's a matter, it may be a little more challenging than it has been in past markets, but there are always deals out there, and I think it's just a matter of finding them. But I think there is absolutely opportunity out there for it. You just have to know where to look and how to find it.
On the podcast today, Peter and Ron are going to share what they're doing differently to make the BRRRR strategy work in today's market. Joining us on the show from Chesterburg, Pennsylvania is Peter Neill and Ron Lockhart. We'll take a quick break to thank our sponsors. We'll come right back and we'll talk to Peter and Ron. It's a lot of work to find a really good rental property. And when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender and her specialty is helping investors finance rental properties. She has a ton of loan programs, and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com, NMLS 42056. Investing in rental properties can be complicated, but it doesn't have to be. My friends at Mid-South Homebuyers sell completely rehab turnkey properties in both Memphis and Little Rock, and they've been doing it for 23 years. All their properties come totally rehab. They put on a new roof, new kitchen, new bath, new plumbing, new electric. Everything is brand new. They also have a tenant that's moved in before you close, so you get cash flow on day one. Mid-South Homebuyers also continues to manage the property for you after closing. It couldn't be easier. Everything is 100% done for you. All their properties also come with a couple of guarantees. They have a 1-year total maintenance warranty and a lifetime occupancy guarantee. Personally, I just closed on my 5th property with Mid-South Homebuyers, and I couldn't be happier. If you want to talk to a happy customer, reach out to me. I'm happy to answer any questions, or you can check them out at midsouthhomebuyers.com. Together, you guys have done over 130 BRRRRs, and most of that has been in the last couple of years. So let's figure out what you're doing. Tell me about one of your recent deals.
So this particular deal is in Baltimore City. A lot of the deals that we get down there, we buy through auction houses. I developed a relationship a number of years ago with the owner of an auction house that handles a lot of the city's vacant housing and the disposition of it. And so sometimes we'll bid at the auctions. Sometimes they'll bring us stuff before the auctions even occur and offer us the properties to buy or portfolios or packages to buy. So this particular property was sourced through an auction house.
So were you able to go in the property before you put your bid in?
Yes. We're pretty streamlined with our analysis with properties, to be honest with you. We have a construction team that's down in Baltimore, so we always can send our construction manager into any project. But to be honest with you, a lot of these, from the pictures that we receive from the auction house, we have kind of a buy box or range that we know is going to work with our numbers, kind of best case, worst case. So we don't necessarily have to get into them. We try to get into them as many as we can, but sometimes we'll be throwing a property at the last minute that we don't have time to actually get boots on the ground. And that's when we'll take a much more conservative approach on what we'll bid up to. But again, we've got a pretty good feel for, we're best case, worst case, and if need be, we can bid sight unseen.
So, and you've got the construction background, so it's, there's probably nothing you can't handle.
No. When I got into the construction business in the late 90s, It was all new construction we were doing. We did custom homes. We built $3 million homes back in the 90s. So what we're doing today is well within our scope of experience.
So are you doing like a full gut rehab in general?
We are. I mean, the
Okay.
property that we're referring to, yes, it was.
Okay. So what did you end up buying the property for?
So we bought this property for $20,000.
Wow. That's really, really cheap. And was it just a mess when you bought the property?
So this property actually was somebody had been living there. Should they have been living there? Probably not. But this was not something that was totally falling down. Those are actually the properties we prefer when they're falling down, because we know we're going to be taking it all the way down to the 4 brick walls and rebuilding. This one was not, but we ended up taking it down to the 4 brick walls.
Okay. And how much did it cost? Like, what was your total construction cost?
The total construction on this was $100,000.
$100,000. Okay, so you're all in at 120, and then what would you say? And so, as far as funding that property, so you're funding it with your fund. You've got your investors that have given you money, and you're using that money to buy the property and then fix it up.
That's correct.
Right? Okay, so you're all in at 120, and then when you refied the property with your long-term financing, what did the property appraise for?
So this property was part of a portfolio loan of 25 properties. And the average ARV was, some of the properties, again, we're buying a different range of properties. The high end of the appraisals was, I believe, 200,000. The low end was like 155. This one was in the 180 range. So if we had to break it out, the loan amount would have been, I think, 125.
125. Okay, so that's your purchase price and then like some closing costs.
That's correct.
Okay, so you're all in at 125. And now with the financing, it gets a little tricky to figure out the mortgage payment when you have a portfolio loan. But like, is there a certain target that you want to profit after you pay the taxes and insurance and any repairs and account for vacancy? Is there a target cash flow you're looking at for each property?
Yes. I mean, our whole model is built around an average based off of the type of properties I just mentioned. And we want a cash flow after debt service, maintenance holdback, vacancy, taxes, insurance. We want a cash flow about $300 to $400 a door.
Okay.
The long-term goal for us, or the long-term payday, is the equity creation and growth in the portfolio itself. Because the way we're doing it with the refinances, you're effectively tax deferring your income until there's a realized gain when you sell any of the assets. And that's really not our goal. We may own these assets 15 years from now. We want to just create as much equity as possible for down the road.
That makes sense. Now, you guys are buying in Philly and in Baltimore. Why are you investing in 2 different markets? Wouldn't it be easier if everything was all in one place?
And it's really about opportunity, and Baltimore is where we're seeing some of the best opportunity right now. So we'll go heavy down there. Philadelphia has been a more competitive market. Philadelphia in general, from a governmental standpoint, has been a little more challenging. New Jersey is a market we love, but it's really tough with the taxes there to make a lot of deals work. So we're opportunistic when it comes to the regions that we're working in, and we want to be able to, look, feel, touch, and because of the nature of our structure, we're handling everything in-house. So it's really not a challenge. We've got really good teams in all the markets. And again, it's just built for what we do.
And for us, Baltimore, it's not even a 2-hour ride, especially if you don't hit any traffic. It's like an hour and a half. So it's not terrible getting down there whatsoever. But to your point, when it comes to investing in certain areas, like we definitely have areas in Baltimore City, in Philadelphia, and to Ron's point, some stuff in South Jersey, like areas that we like and that we look for product in. And we do have the blinders on to some extent because I like to kind of say, like, we take a commercial approach to the single family space in the sense that with scale comes a lot of opportunity for efficiency and for efficiency in the process and in the management, but also in the finances and just being able to spread to get certain discounts and things like that that come with doing things at scale, the economy of scale that's created from a financial perspective as well. So we definitely look to grow our portfolio in certain areas and see a lot of benefits of that. And I think that's kind of a very different approach to single family that a lot of mom and pop investors, typically don't necessarily take. They might only want 10 or 20 properties, and when it gets beyond that, it gets difficult to manage. For us, we see it as the larger the portfolio is, the easier it is to manage in some ways. And we've been able at our scale now to have really good team built out and have good people around us. And we feel as when we continue to grow that's only going to get better. So we look at single family, I think, in a different way and kind of take a commercial look to it versus what you maybe would see, some mom and pop investors look like, where they maybe only want to hold so many properties at any given time so that the management for them isn't too hectic or something like that.
That makes sense. Let me ask you about Baltimore. Yeah, I've looked into Baltimore before. I mean, there's a lot of opportunity there, a lot of cash flow. But what I could never figure out is that Baltimore seems to really change block by block. That you'll have a block that's a nice, safe block, and then you go a block and it's an area you probably don't want to invest in. So was it hard for you guys to figure that out?
Any market that we're invested in, we do significant due diligence before we spend a dime. And Baltimore was really no different than any other market we've gone into. We look for drivers, drivers for demand in particular. There was already a lot of demand for affordable housing in Baltimore, especially on the Section 8 side. So we would look for what are those drivers, and we tend to focus around hospitals in Baltimore. It's not to say that we don't venture into some other areas, because we do, but primarily it's hospitals. So once we zeroed in on that, it was pretty easy to develop our investment thesis down there.
Yeah.
The hospitals do what they call community investment. The hospitals we're investing around own a lot of property, own land around them. They don't want to be in war zones. They want to be in good areas, so they invest in those areas. And it was something we didn't set out to do. I wish we were smart enough to know that off the bat, but it was something we realized as we've examined our portfolio over time, and it's something we've leaned into and definitely see those areas growing with that investment. And then you'll look at crime maps and school districts and things like that too. But to Ron's point, Philadelphia is the same way, and probably any major city is going to be similar, where there's areas you want to be in and there's areas you don't. Baltimore might have a few more so than Philadelphia does. But once you've been there and you're investing in there and you're buying properties there, and we have really good local connections through attorneys and through agents and wholesalers, and like Ron said, the relationship with the auction house. Where we're always looking at, where's the city headed, where's the development headed, where are there to what Ron was saying, the drivers, the value generators that are going to drive more, development in the future, that kind of thing. But and then too, we want to see a vibrant for sale market that isn't just other investors. You tend to see that, I think, more in the war zones and lower type of areas where only investors maybe are buying in those areas. We want to see a healthy amount of regular homeowners buying as well. It gives us options when we're doing what we do, because typically we're not competing with homeowners on a purchasing side because we're buying fully distressed properties. Most homeowners aren't going to want to go in and do $100,000 worth of renovation. Most investors don't either. I'm always blown away when people call me with property and they're like, oh, it's a big renovation. You might not want to do it. And it's like, that's what we specialize in. But a lot of investors, I think, if they're outsourcing the construction, they focus more on the value add stuff, something they can get in and out of quickly, and at a relatively light budget. So for us, we like to see those areas where there's when a property is finished, we would have the choice to lease it, or we would also have the choice to sell it on market to a regular homeowner.
Let me ask you about your management of the properties. So it sounds like you guys are doing that in-house, or do you have local property managers?
So everything we do is done through a portal. So there's no phone calls. It's all submit. I mean, there are numbers available if there's an emergency, but maintenance requests, any communication like that is all done through a portal. So we have our managers tagged for whatever properties or regions that if any communication comes through the portal, it goes directly to them.
Wow. So your tenants are never calling. They're always going online to your portal, filling out maintenance requests or whatever else they need. Like it's never a phone call.
I would say 90% of the time they're utilizing the portal. With any sort of scale, you're going to have people that like to try and do things the way they want to do them. But we also, when that happens, our response is, please communicate through the portal, because if there's a maintenance request, we have our own maintenance teams. We request video, pictures, so we know what we're trying to address. So we're not wasting time sending somebody out, taking a look, and then having to go figure out what materials they may need. Do we need to send one of our plumbers or electricians, a framer, whatever it may be? So a lot of times we know what we're going to look at, and they can take care of the maintenance the first go around, not the second and third.
So you guys seem to have a really good system. You've got everything figured out. You've got people that are able to do different roles. For someone that's maybe just getting started, maybe they have a couple of properties or a smaller portfolio, is there any advice that you would give them to go from one or two properties to start moving towards where you guys are today?
So I would probably start with private lending and utilizing your own cash. I know a lot of people say buying properties with zero money down, and you could certainly do that. But I think it's important, if you're looking to get investors and you're looking to scale, they want to see that you have skin in the game, and they want to see that you have some savings and you're able, if you're successful and you're a good manager and all, why do you have no money and why can't you put any skin in the game? You know what I mean? I think you might run into some issue there, but so I think it's important to look at where it is that you want to go and find people that have done it, and then and just work one day at a time. You got to lay the bricks out one day at a time, and this is not a business where you're going to find success overnight. It takes time.
Ron, what about you?
I think investing in real estate, single family real estate, is really good for people from a diversity standpoint. But I always caution people, you got to be careful what you're getting into. On the surface, it can seem really easy. There are a lot of advantages to it. It can create cash flow. It can create equity growth. There can be tax advantages. But where I always see people fall short, is they find a deal that they think is a good deal, and it may be a good deal. But if you don't have the experience and the right people, that you're working with on the construction side, especially if it's significant construction, that's where I see people really get hurt. And it's understanding the process. There's safeguards you can put in place to make sure you're not taken advantage of, that, you're not spending more money than you should. But I think a lot of people look at it and think, oh, this is easy, I can do this. And they find out pretty quickly it's just not that easy. They think things should cost less than they actually do. And, if you're running the construction yourself, you're probably saving anywhere between 25 and 35% on the actual cost. And that's significant when you're trying to make a deal work. And I think, going back to, the question you asked us in the very beginning about, the BRRRR method and some people thinking it doesn't work in this market, I think the construction piece of it is a huge component of it working and not working. So, I think it's great. I think it for people who are trying to add additional investments to their portfolio. But I just would caution them, it's just not as easy as it looks.
I'm really glad you said that. I think a lot of times people make the BRRRR strategy sound like it's very simple. It does require hard work and it does require some knowledge, but it's not impossible. You just have to work for it. One thing that Peter and Ron said that I think was really good advice is that when you're looking for an area to invest in, look near a hospital. That most hospitals aren't going to be in war zones. They're generally in decent areas. And I think that's a good way if you're looking for an area to invest in, look near a hospital. Well, if anybody wants to reach out to Peter and Ron, I've got their contact information on the website. You can find it at rentalincomepodcast.com/episode 502. I'd like to thank Chaley Ridge from Ridge Lending Group for making today's episode possible. If you're looking to buy a rental property, whether you're just getting started or you want to add to your portfolio, reach out to Chaley. She's got a ton of different loan programs, and she can find something that'll work for you. You can find out more at ridgelendinggroup.com, NMLS 42056. Thank you so much for checking out the podcast today. Make sure you hit that follow button. I put out a new episode every single Tuesday, and if you're following the show, you'll get notified as soon as the next episode comes out. My name is Dan Lane, and this has been the Rental Income Podcast.